Hyperliquid expands. HIP-4 event contracts to macro bets. Target's Polymarket Hyperliquid is extending its HIP-4 outcome contracts beyond crypto-native markets into macro and real-world events, according to CoinDesk. Traders can now take yes or no positions on items like U.S. inflation prints, Federal Reserve rate decisions, and NVDA earnings beats, alongside the venue's existing perp markets. The launch lands during a flat tape. Bitcoin was at $76,160 as of May 26, 2026, down 0.6% on the day, with ETH at $2,100 and SOL at $84.60. The Fear and Greed Index sits at 39 in fear territory. Hyperliquid is moving on product while sentiment is soft, not chasing a rally. Binary settlement, capped downside. HIP-4 contracts are fully collateralized binary instruments. Each position settles at either 1 USDC or 0 USDC at expiry. Traders buy yes or no at a price between those two endpoints, and the maximum loss is the upfront premium. There's no liquidation risk, no funding rate, and no leveraged exposure of the kind that defines Hyperliquid's perpetuals. That structure puts the product closer to a Polymarket share than to a perp. It also makes the markets approachable for traders who want directional exposure to a known event without the margin mechanics of a futures position. Validator-run settlement versus UMA. The competitive angle is how the markets resolve. Polymarket relies on UMA's optimistic oracle. Outcomes are posted, and UMA token holders can dispute and ultimately vote on contested resolutions. That design has produced public fights over how questions get interpreted, including the Ukraine election market and a series of sports outcomes earlier in the cycle. Hyperliquid takes a different path. Validators ingest news feeds, decide which markets to list, and vote on settlement directly. The settlement layer is the same validator set that runs the rest of the chain, not a separate token-curated dispute system. Hyperliquid is pitching that as a way to avoid the situations where a Polymarket dispute pool determines whether a fact actually happened. The trade-off is concentration. Polymarket's UMA dependency widens the trust surface, but also widens the set of parties who can challenge a bad call. Hyperliquid's model puts more weight on its own validators behaving correctly. Traders considering size in these markets will need to form a view on which failure mode they prefer. Off-chain subjects, on-chain execution. The contracts themselves trade on Hyperliquid's order book and settle in USDC, but the questions they reference are off-chain: a CPI release, an FOMC statement, a quarterly earnings number. That is a meaningful shift for a venue that built its reputation on crypto perps. Hyperliquid is now selling exposure to events that have nothing to do with on-chain activity, using its own validator set as the arbiter of what happened in the real world. Earlier this week, we covered how Hyperliquid is recycling more than $116 in fee revenue into HYPE buybacks. Event contracts add a second revenue surface on top of perps, with the same buyback flywheel sitting underneath. The Polymarket Challenge Polymarket has spent the past 2 years building a brand around election betting, sports, and macro outcomes. It has the brand, the user base, and the integrations. What it does not have is a high-throughput exchange backend or a native token economy to subsidize liquidity. Hyperliquid arrives with both, plus a settlement design that bypasses the oracle layer that has been Polymarket's most litigated weakness. Liquidity will decide the contest. Polymarket's depth on flagship markets is hard to dislodge, and traders who already hold positions there have switching costs. But Hyperliquid has shown it can pull volume quickly when it lists a new product class. The first real test will be the next CPI print. Whether spreads on the Hyperliquid market are tight enough to attract directional flow that would otherwise sit on Polymarket.